Index Universal Life Insurance, or IUL, can be a very powerful financial tool. It offers cash value growth, tax benefits, and tax-free death benefit for your family. But here's the truth. Not every IUL is created equal. Most people hear about IULs from friends or family and assume their policy will be set up properly. But if you're not careful, you could end up with a policy that works against you, not for you. In this video, I will break down 6 red flags you absolutely need to watch out for before signing your policy so you can avoid costly mistakes and set yourself up for success. Hi, I'm Gilbert, and I'm here to help you make informed decisions about life insurance without all the fluff or misleading promises. Let's dive into the 6 red flags you need to know about. If your goal is maximum cash value growth, you must start with an increasing death benefit option. Here's why. So we have a 35-year-old male who wants to contribute $20,000 here, and we have a starting death benefit of $390,000. We're using $390,000 here because it allows us to be able to do so. So you can see the initial guideline annual is a little over $20,000, which represents the amount of money the IRS will allow you to put into the policy every single year. So we're able to put in a little over $20,000 every single year into the policy. That works good. If we want to use a level death benefit option, so let's see, if I switch to a level death benefit here, you can see that you're only allowed to put in just over $6,000, about $6,500 here. So in order for you to put in $20,000 every single year, what we do is that we have to increase the death benefit, and we are going to need about $1.2 million here. So when I increase the death benefit option to $1.23 million, that will allow us to put in $20,000 every single year. So what it means is that a level death benefit option has a higher death benefit requirement. And when you increase the death benefit, it means the cost of insurance is going to be more expensive. Let me show you that. So right now we have the level death benefit, $1.23 million. When we go to the expenses here, now I want you to only focus on the cost of insurance for now. Don't worry about the other columns. If you want to understand it, I have a dedicated video. I'm going to put it in the description below. But if you look at the cost of insurance, we are starting out a little over $1,000. By year 15, we're around $875. Okay, let's compare it to when we go back to an increasing death benefit option. So if we go back here, we switch to increasing death benefit option, and we go back to the amount of death benefit required to contribute $20,000 here. We're allowed to do that because the guideline is just over $20,000. And if we go back to the expenses, we can see that we are just over $421. So the cost of insurance is lower when you start this way. It's far lower. And so that's why we're saying that if you want the most cash value growth, you want to start with an increasing death benefit option. And when you stop funding the policy, then you can switch to a level death benefit option. Let's go to the second red flag. The second red flag is when we see 0 in the cash value column. So we are putting $20,000 into the policy. Year 1, cash value 0. Another $20,000 cash value in second year is also 0. You see, this is a bad design. You are not able to borrow money from your policy within the first 2 years. And if for whatever reason you drop your policy or you surrender it, you get nothing back, even though you have put $40,000 into the design. It's not an IUL problem. It's a design problem. The agent setting up this policy is doing a bad job. Basically, that's what it is. But once you see a 0 here, you want to ask questions about this. In this design, we are doing a level death benefit option here. And level death benefit has higher expenses. So we are not able to have any cash value. When we just switch it to an increasing death benefit option here, you can see that we now have some cash here. Now, even this one is not the most optimized. And as we go through all the 6 points I'm going to talk about, you will see how we can make it better and better overall. But increasing debt benefit usually should show some amount of money here in the column. If you have an increasing debt benefit option and you are still seeing 0 here, it just means that the debt benefit that you are starting out with might be a little too high for the amount of money that you are looking to pay into the policy. So sometimes you still have increasing debt benefit option, but if that debt benefit is so high for the amount of money you are paying into the policy, then you could still see 0 here. So that's one of the things you have to be aware of. In that case, it may not necessarily be a design problem. It's just that how much you are funding it compared to the debt benefit that you are starting with might not be the best. So you want to ask questions around this. All right, so that's the second one. Let's move on to the third red flag. The guideline annual premium is the amount of money the IRS allows you to pay into your policy every single year. So for instance, I'm back to our design here. This is increasing the benefit design. We're starting with a $390,000 here, and $390,000 because it allows us to have a guideline annual premium of just a little over $20,000 here. So if I'm planning to pay $20,000 a year into the policy, this makes sense because the premium that I want to put into the policy is $20,000 and the guideline level premium is just a little over $20,000. My premium is as close as possible to the guideline premium. And that's what we want. We want the amount of money that we've decided to pay into the policy to be as close as possible to the guideline level premium. Assuming for whatever reason, my agent set me up for, let's say, $1 million here. When I increase the debt benefit to $1 million here, my guideline level increases to $52,000. So that means I am able to put in $52,000 every single year into the policy. But if I don't ever plan on putting $50,000 into the policy, it just doesn't make sense, right? It means I'm paying for way more cost of insurance. But if there's no need for that, then we don't want such a high guideline level premium if we don't ever think of paying $50,000 into the policy. Now, I want you to understand this. Sometimes we may not start out paying $50,000, but maybe we plan on doing that down the road. Maybe we are anticipating some bonus in future years, and we might want to build in some max space into the design. That's okay. As far as you know why you are getting extra space, then that's fine. But most designs I've seen, you have a very high debt benefit and the person is only contributing $500 a year into the policy. And usually when you ask them, hey, why do you have such a debt benefit? The client's response is, I just don't know. That's what my agent gave me. And usually this is a bad design. We don't want just a high debt benefit because an agent wants a huge commission. No, that's not what we want, right? We want to get just enough debt benefit as we need to either contribute into the policy or whatever we think we need for protection for ourselves. We just need just the right amount. So when you have your design, you want to find out, what is my guideline level premium? Does it match whatever I want to put into the policy? Or if it's far bigger than that, is that what you decided? Is that something you are aware of? It's a red flag. Now, let me show you usually how this looks in an illustration. So if you look for the guideline level in your illustration, you're going to find one of it with a number. So in this design, the guideline level is a little over $20,000. And when we go to the actual numbers, you can see that we are contributing $20,000 a year into the policy. So as far as the max space, this makes sense. Just over $20,000, and we are contributing $20,000 into the policy. So this makes sense. But whenever you see a huge difference between the guideline level and the amount of money that you intend on paying into the policy, that's a red flag. You want to understand why such a design is being chosen. All right, let's move on to the next red flag. The next red flag is no blended term insurance. Blended term insurance is the secret sauce for an efficient IUL policy. Here's why. It reduces the expenses, especially the agent's commission, and it gives you access to a higher percentage of your money upfront. This leads to better cash value growth over the long term. Let me show you what I mean. So in this design, we're contributing $20,000 a year into the policy. And when there is no blended term insurance, we're contributing $20,000 into the policy. Cash value is just $3,500. And second year, $20,000, we are seeing a total of $2,300 here. So this is okay design. This is what most agents design. Now, when we do a blended term design, I'm switching to the blended term design here. Again, same design, same product, same contribution here. You can see that we're paying $20,000 into the policy, but we have $15,000 upfront. You might ask yourself, what is the difference? And it's because one of them is using blended term insurance, which doesn't pay commission. So more of your money is available upfront. And if we look at the numbers, short term, long term, the one with the blended term insurance is going to do far better. When we look at also the cost of commission paid out, let me go back to the first, the increasing death benefit with no blended term insurance. When we look at the commission, this T here represents the target premium. Or if you look up for the target premium in the illustration, here says there are about $7,000 in commission that's going to be paid out. So when you see TP, bottom right of the illustration, it's a measure of the commission, about $7,000 here. But when we blend term insurance, it reduces the commission. And so you can see here we have just about $1,800 here. So when we blend term insurance, more money is available in your policy upfront. You're able to borrow more, and also the expenses are lower. And so look out for blended term insurance. Now, there are some times where we might not have blended term insurance, which is when you are contributing a very small amount. Maybe you want to do $100 a month, and the minimum death benefit required in the product is, let's say, $100,000. In such case, then blended term insurance might not work there. But most of the time, if you are putting some good amount of money into the IUL policy for growth, if you can get a blended term insurance, you should get, it gives you more money upfront, and it leads to lower expenses than when you go without the blended term insurance. All right, let's go to the next red flag, and that is missing expense page. IULs are more transparent than whole life policies because they include an expense page that breaks down all the fees. However, some agents choose to leave this page out of the illustration. I mean, I don't know why or whatever reason an agent can give that justifies leaving this crucial page out. And if your IUL illustration does not have the expense page, you need to ask your agent, why am I missing my expense page out? Let me show you how it typically looks like. This is how the expense page looks out. It breaks down all the various fees in the IUL policies. Now, these fees will vary by product, but some of the columns will be similar across. So if you have an IUL illustration and you don't see anything like policy charges or ledger or anything that shows the fees in the product, you need to talk to your agent and ask him to give you an illustration with the expenses in it. I mean, like I said, I don't know why someone will like to leave this page out. I mean, if I'm buying a policy, I would like to see it. And that is why you want to have it included in your policy. The next red flag is about the interest rate used in the illustration. Be cautious of IUL illustrations that use an interest rate above 6%. IULs are not the stock market. While they protect you from market losses, there will be years with zero returns, and no one can predict how the stock market index will perform. And using rates above 6% might set unrealistic expectations. This is really crucial when you are trying to compare two IULs. Usually people want to just look at the numbers and think, oh, this IUL is better than this IUL. But that is not the case. And one of such factors that affect the numbers a lot is the interest rate used in the illustration. So let me show you what I mean. When creating an illustration, an agent has to choose an index as well as how much we want to allocate to that index to generate the illustration. So for instance, we can see here that we have different index choices and there are different assumed rate. So if I were to select one of these index and I have an assumed rate of up to 7.42%, it means I can illustrate the numbers at 7.4%. Now that will generate different numbers from when I use 5 or 6%. And let me show you what some of these numbers could look like. So if you take a look at the actual illustration here, we get some examples assuming we're illustrating at 4%, 5%, and 6%. For the cash value at age 70, you can see that it's very, very different when we change the numbers. So at 4%, we're seeing around 1.4 million, 5% around 1.7 million, 6% around 2.2 million. So very different based on what interest rate we are using for the illustration. And so if somebody is out there using 7.4% to show you numbers, obviously it's going to be very huge and that might seem enticing. But usually we're just setting ourselves up for failure because we're setting the expectation very, very high. And IUL is not an aggressive vehicle. It's a defensive first vehicle. It tries not to lose money instead of trying to go for big gains like stocks. So make sure, I think 6% is a sweet spot, nothing more than 6%. You can go lower if you want, just to be a little conservative, but 6% is really where we want to be at if you are looking to compare two IUL designs. Make sure they are both using the interest rate. That way you can look at the numbers if that's how you want to go about it. So we have covered the 6 red flags you need to watch out for when you're trying to get an IUL policy. The product is not the problem. It's how it's designed and managed that makes all the difference. Take your time, ask the tough questions, and make sure your policy is designed to fit your goals. Now, if you're thinking of getting about IUL and you want to get it right, or maybe you have an illustration, you're not sure how to look for all these red flags and you need assistance, feel free to reach out to me. I'll jump on a one-on-one session with you and we'll look through and see if it's the best design. That way you can go back to your agents and make sure they do it the right way for you. But my contact is going to be on the screen and also in the description below. Feel free to reach out to me. If you got value out of this video, please subscribe, like this video, and let's make sure more folks get the right products. Thank you for staying with me. I will see you in the next video. Bye.